you are studying for the CFA exam, this is one of those topics that looks easy until you see how it's actually tested. Organizational structures, corporate issuers, and ownership. On paper, it's just definitions. But in reality, this is about who controls a business, who provides capital, and who actually takes the risk. So in this video, we're not just going through theory, we're going to walk through this like an analyst would, using real intuition and real world examples, not just textbook language. By the end, you should be able to clearly distinguish every organizational form, understand why corporations dominate markets, and interpret ownership structures the way CFA question expected to. Let's start from the ground up. In most market economies, organizations are mainly grouped into three distinct groups. First, governments, second, non-profits, and third, businesses. In this video, we will mainly talk about businesses. Before we go one by one through each business structure, I want to give you a mental model. Every organizational form is just a trade-off between three things in the end. First, control is who makes the decision and how concentrated decision making is. Second, liabilities. Who is financially responsible for the losses? Third, capital access is how easy is it to raise money for the business structure. If you understand those three dimensions, you don't need to memorize anything and you can just derive everything from here. Let's start with the simplest structure, the sole proprietorship. A sole proprietorship is a business owned and operated by one individual only, and that's the owner. But that definition doesn't help you in the exam. Here's how you actually think about it. First, control. The owner has 100% control over the business and makes every decision himself. There's no separation between him and the business. That comes with a downside, the liability. This is the catch here. Even though he can make every decision, there's also no legal separation between him and the business. If the business loses money, the business gets sued or it defaults on debt, he's personally responsible and his assets are personally exposed. That means his house, his savings, everything is exposed. On the other hand, additionally, capital access is extremely limited. The owner can use his own money or borrow personally, and that's important. You can't borrow in the name of a sole proprietorship, you borrow in your personal name. So the bank only gives you loans in your name, not in the business name. You also can't issue equity on the stock market, and there is no mechanism to bring in outside investor money easily in a scalable way. Think of sole proprietorships when you think about a freelancing consulting, a small local shop, or a solo developer working at home. This structure works when the business is fairly small. The risk to it is limited, so you don't have to loan against your personal assets, and the capital need in general is low, so you don't have to go to the bank and loan in your name. The moment you want to scale this business, this is where it starts breaking and you need to go to the next level, which is a general partnership. In a general partnership, you now don't have that one owner anymore, you now have multiple owners, and those two or more partners share the ownership. So this basically means the ownership can be shared equally, so partner A and partner B both hold 50% of the business, or there's an agreement that says partner A has 75% and partner B is 25% owner. But here's the key risk. Each partner can act on behalf of the business. So that's where it's getting dangerous. There's unlimited joint liability. That means you are responsible for your actions and your partner's actions. So if your partner makes a bad decision, you are still financially on the hook and you still have the same liability that you had in the sole proprietorship. Additionally, not just for your actions, but also your partner's actions. The upside here is that the capital access is a little better than the sole proprietorship, but it's still limited. It's just because now instead of only you getting personal loans, now there's more than one person that can has access to capital. But again, there is no public equity and it's still limited scalability. If you think about sole proprietorship, general partnerships, you can think of law firms, small investment partnerships, or early stage businesses. General partners work best when the trust between the partners is high, and in general you want a small number of partners. But as complexity increases, this structure becomes very fragile, which brings us to the next level, the limited partnerships or LPs. Now we can finally introduce a critical distinction. There's two types of partners now, not the equal partners that we had before. Now there's a general partner and there is a limited partner. The limited partner are only there to provide capital. They now have limited liability. They don't inherit the full liability anymore that we had before in the general partnership. And because of that, they give up their liability, but they also do not manage the business. That's the general partner. The general partner runs the business, but he also has full liability for the business. And this structure is the first that truly separates control from capital. And that's a big deal. The control is centralized with the general partners, whereas the liability also is with general partner, and the limited partner have only limited liability in the sense that it's only limited to their investment. That brings us to the capital access. The capital access here, by definition, now is much better because you can bring in passive outside investors. But still, the ownership is not easily transferable and you're still not publicly traded. In the real world, this is where the real world example, this is mainly private equity funds, venture capital funds, or hedge funds. In those cases, the fund manager is normally the general partner and the investors are our limited partners. The key CFA insight is that the limited partner must not participate in management. If they do, they risk losing their limited liability status. And that's a classical testable point in the exam. The last business structure we will look at is the corporation. And that is the dominant structure in the market. This is where everything changes. A corporate is a separate legal entity from its owners. It has now indirect control in a sense that shareholders don't run the business. The shareholders elect a board of directors. The board of directors then hires a management and the management runs all the operations. This is called separation of ownership and control. Talking about liability now. The liability is very limited. As a shareholder, your maximum loss is actually your investment into the company, and that's it. So you can invest by buying Apple shares, and even if Apple defaults, you are not personally responsible with your personal assets. The max you can lose is your investment into your company. The big advantage of corporations is the capital access, and corporations can issue equity, for example stocks via IPO, they can issue debt in form of bonds, and they can access global capital markets. And this is why corporations scale so big. Another big advantage is transferability, where the sole proprietorship or general partnerships is it's hard to transfer your shares. Now in the corporation, you can just easily buy, sell, and trade shares of a company, which creates liquidity. Real-world intuition or real-world examples are companies like Apple, Microsoft, which have millions of investors, and each investor can own a small piece of the business without being responsible to manage the day-to-day business of Apple. The trade-off here is, before we talk about the trade-off, let's summarize everything that we talked about earlier. We have our three business forms, the four business forms, the sole proprietorship, general partnership, LP, and corporation. We look at our three dimensions: control, liability, and capital access. Starting by the sole proprietorship, the control of the owner is basically unlimited, and so are his liabilities, because he's the only one responsible for the business. He can also not get a lot of capital into his business because he can only loan against his own name. If we move up to the general partnership, the liability is still unlimited, because even if you have more than one partner, you are still responsible with each partner is still responsible with his personal assets. The control is now split, and you have a little bit better access to capital. In the limited partnership, you have the general partners have more control over the business, but finally they give up some of the liability, and the access to capital is higher, in the sense that limited partners can now finally invest in the business. The corporate now gives us unlimited access to capital, and we finally split, or we don't have any liability with our personal name, but also we have to give up the control, because the control is just in form of the management of the business. The points that we just discussed in the plot up here, the limited liability, the easy capital access, and the control, are the main points why corporations are the preferred business structure if you want to scale your business. It's just that the owners are not liable with their personal assets. The ownership can easily be divided into shares. The management can be delegated to professionals, and businesses can capital from much larger investor base. So what's the downside of being a corporation then? The main downside from an investor side and the corporation side is double taxation. Double taxation is that the same profits that a company make get taxed twice in the end. Once by the corporation, once by the investors. Let's look at a real life example here, and we look at actually reported numbers by Apple in the 2025 annual statement. Apple reported a pre-tax income of $132.7 billion. They also reported that they paid $43 billion in taxes that year, which leaves a net income of $89.4 billion. So keep those 43 billion taxes in mind. Apple now paid dividends of $15.4 billion to their shareholders. Now let's assume on average all our shareholders have a tax rate of 20%. 20% of our 15.4 billion is 3.1 billion. So additionally to the 43 billion that we pay another 3 billion in tax and that is inherited by the shareholders, not the corporation. So the cash kept by the shareholders is not the 15.4 billion, it's 12.3 billion. So to summarize this, Apple gets taxed 43 billion on their pre-tax income. It then decides to pay a dividend of 15 billion, where the shareholders get taxed 3 billion again. So in total we paid 3 billion plus 43 billion, which is $46 billion in taxes on the pre-tax income. The main point here is that the pre-tax income is taxed twice, once by the corporation and once by the shareholders in form of dividends. Now let's refine corporations a little further. There's two main forms, public companies and private companies, which both have a trade-off in their own. For public companies, shares are traded on exchanges. This gives them a high liquidity. It gives them a price discovery, so the company trades on a fair price that outside investors value the company at, and it also gives you a lot of transparency with it. But it also comes with heavy regulations and heavy disclosure requirements. So you have to file your statements, you have to adhere to the SEC and so on. Private companies, on the other hand, have no publicly traded shares. This gives you more control over the business, and you can have less disclosures in the end. But you have limited liquidity, and it's harder to get capital access. To go from public to private, there's mainly three ways. First is an IPO, so you raise new capital by selling your stock on the market. The second is direct listing, which only gives you liquidity in the end. And the third one is a SPAC, which is merging you into a public company. A SPAC is kind of a shell company that acquires your business, and then in that way you get listed. The other way around is going private. It's basically the reverse process. You buy out the investors, or buyout investors acquire your company, and you buy out all the investors in your share by purchasing back all the share. That's what happened to Twitter a couple of years ago. You basically delist all your shares, and then you often restructure the business. Lastly, let's look into the ownership structure of a business. Let's connect this to real markets here, and we look at the example of Apple again. Ownership of a public company is typically dominated by three main players: institutional investors, insiders, and the normal retail investors or other investors, which are the retail investors are basically us, the normal person investing into the business. Why does ownership matter? Different owners have different incentives. Institutions, for example, are long-term and they want to be diversified. Insiders, they have control over the business and make strategic decisions. Retail investors are often more short-term to get their personal gain. So when analyzing a company, you're also analyzing who owns it. In the form of Apple, we can see that insiders hold around 1.6% of all total shares. Insiders here being people like CEO Tim Cook, who owns a significant amount of Apple share because he gets partly paid, or his bonus is partly paid in shares, so he accumulates a lot of shares. Other ownership is everything that is retail investors, for example. So publicly floating shares owned by normal people. The biggest chunk of Apple's ownership makes up institutions. We can see that institutions like Vanguard own almost 10% of the company. BlackRock owns around 8%, State Street around 4%, and so on. So you can see that even though Apple is publicly traded, a big chunk of the corporation is actually owned by other institutions. Let's tie everything together. This entire chapter is about one thing: how capital is organized. The sole proprietorship is simple but limited. The partnership is shared risk but limited scale. The corporation is scalable, liquid, and dominant. And the reason corporations win is not theoretical, it's structural. They solve the three key problems: risk, capital, and transferability. If you understand this the way we just talked it through, you don't need to memorize definitions anymore. You can reason through any CFA question on this topic, and that's the goal. Not memorization, but understanding how the system actually works. If this helped, go back to the sections and try to explain each structure in your own words. That's where it clicks. And if you want more breakdowns like this, where we take CFA material and connect it to real world intuition, that's exactly what this channel is about. See you in the next one.